Hello, I'm Jared Schote, and welcome to my discussion on how to make money in stocks by William J. O'Neill. I will begin with my general impressions and some themes that I encountered throughout the book. I will then move into the methodology advocated by O'Neill in the selection of stocks. From there, we will go to portfolio management, then discuss the trading philosophy, and then conclude with some key learning points that I had from the typical mistakes made by investors. In addition to being a great portfolio manager, O'Neill also has some marketing skills. He is the founder of Investors Business Daily, which he promoted heavily through the book. And why not? He wrote the book, and he's the founder of Investors Business Daily. But it's easy to see why. After you learn his CanSlim method, the data and research that's provided to subscribers of Investors Business Daily, it really allows them to execute the analysis necessary for the stock selection under the techniques and paradigms of O'Neill. I appreciate the context that the 50 to 60 years of market research provided in the book, whether it was for the bull and bear cycles or stock performance over time. O'Neill also provided his first-hand account of experience for the things that didn't go so well, and we were able to learn from them. And then what he did well, which affirmed his techniques and methodology for stock selection. As far as the efficient market hypothesis goes, I think it goes out the window. I don't think he's an advocate of weak form efficient, a market, especially not a semi-strong or strong form, given that he is basing stock selection on past performance, current performance, all the available trading information, and still believing that you can purchase these stocks and experience great gains in returns greater than the market or general market indices. As far as portfolio management, I will discuss this in a later slide, but it's really about cutting losses, having a few big winners, and constantly updating your analysis to find those big winners. Timing in the market was a big theme throughout the book. A lot of that does go into his chart analysis of finding a consolidated price base point and all of those type things in the different historical charts. But a lot of it has to do with buying stock and achieving gains and making money during the bull market. He made that very clear as far as when a contraction or market correction or bear market begins. He's about reading that situation and getting your cash, whether that is to sit and wait for the next bull cycle or to pay back if you're investing on margin. Investment versus speculation. This has been something that I have spent a lot of time thinking about over the semester, and that is, I always, especially from reading Peter Lynch, the Warren Buffett, and those parts in that assignment, I wanted to be a long-term investor. I wanted to find something that I thought had intrinsic value and invest in it and invest in its growth. Although he presents it in a different way as far as viewing speculation and viewing investment. He almost views speculation, as far as his approach to it, as a very rational speculation to observe what is going on and reacting to it to profit. Whereas investment, he describes as these are the individuals who, come rain or shine, will hold their investment over the long term, which he's saying is a riskier prospect, given that if you're in it for the long haul and things turn against you, you may be less willing to abandon that ship and you may ride it all the way down. And then I also liked his typical investor mistakes. He kind of highlights them in a chapter, and I supply them in the conclusion of this presentation. But a lot of those things are about behaving rationally and being able to secure profits and stem losses. And now we'll discuss the foundation of the book, which is the CAN-SLIM method for stock selection. When I look at this systematic approach for stock selection, it reminds me of the SWOT analysis that's generally used in risk management, so strengths, weaknesses, opportunities, and threats. It reminds me of looking at the firm's performance. That's the strengths and weaknesses. That's that internal environment. And then as we look at these other aspects of CAN-SLIM, that's looking at industry or the market as a whole, which are the aspects of the external environment and how it can affect our firm in its stock price performance. So as we look at current quarterly earnings per share, we're looking at the past 3 quarters, or the most recent 3 quarters, and their corresponding quarter of the previous year. And we want to see an 18 to 20% increase in earnings per share, but we want to see that as a true earnings per share. So if there has been a non-recurring profit stream, such as sale of land or other large fixed asset like plant, that's non-recurring revenue that's going in to influence and cause an upward pressure on the earnings per share. We want to really see it paired with sales, a true growth in the business. So related to annual growth trends, we're looking at the past 3 years and seeing increased growth. As far as new products, new management, new highs, we're looking for the next star performer. What's that product that everyone wants? Is it leading in its industry? Is it gaining market share? Is the management more entrepreneurial than just being a caretaker? Is it wanting to achieve new highs and new growth? So all those things being kind of the internal environment of firm performance. On the right hand side for SLIM, we have things that are for the industry or market as a whole, so the external environment. So we're looking at supply and demand. Where are these pressures on price? A lot of that being institutional sponsorship down there for I. Those, the large volume traders that are able to kind of be market makers, they can really influence the price based on supply and demand for their volume that they're willing to buy. So all of the firm's performance or the market cycle that will influence these institutional sponsors or investors to supply that pressure on price. The leader or laggard, this is a little more industry specific, but can tie into the market cycle in that you want the leader in the industry. You want that next star that everyone will eventually jump on the bandwagon, demand more of that stock, drive that price up, and then hopefully you can sell it and get good returns. But you're also wanting to find the industry that's the leader of the bull cycle. If it's a supporting industry, then it may be a laggard, and you will not be able to ride those price increases or stock appreciation through the full bull cycle until it's time to sell and get the cash to either pay off your margin accounts if you're investing on margin, or get cash and hold it and wait out the bear cycle and wait for the next chance to invest again and achieve great gains in the bull cycle. And all that really feeding into market direction. His advice on portfolio composition I thought was very interesting, given that I thought he took more of a speculative view versus long-term investing view. I thought it was interesting that he would advocate mutual funds, but still you can still select a good mutual fund, whether it's high growth or all the other different classes of mutual funds, but take advantage of that compounding that's there. So he really liked stocks, mutual funds, and real estate. I thought it was interesting that he said that futures and options were too risky and speculative, but he really liked concentration, so choosing the right stocks. A lot of that going into his methodology of spending so much time and effort on the analysis. Choose some big winners. Don't just pick a basket of stocks and have some losers, some mediocre performers, and then some winners. He really looked at constantly trimming off the losers. You might have a few mediocre performers, but you want to have a few major performers of good returns. The message of a trading philosophy was very beneficial to me through this text in relation to psychological and technical aspects of trading. I think I was irrational and was victim to the emotion side. I think I was proud and stubborn. When we created our stock track portfolios, I had made some decisions to really be low risk and expect moderate return and just kind of be in the middle of the pack. And while that played out for a little while, I started experiencing some losses and I ended up in the bottom third of the class. I didn't like that very much, and I had read this book and I had decided to make some changes. Some on the emotional side, admitting that I had made a mistake and that I was on the wrong path, which is a lot of the battle, and then taking action to correct it. So, stemming those losses, getting rid of those losers, and then making better stock selections to go forward and not be emotional. Be a little more rational, and then have an exit strategy as well. So that's the next point, is having the plan. It's great that he discusses how do we select, spending so much time on the technical aspects and the analysis for selecting a stock, but having the full strategy to execute a position and to ultimately make money in stocks. The analysis aspect, I think fuels that rational, non-emotional side of the trade. So you're doing the fundamental analysis. You're really looking at the technical aspect of the chart reading with the, teacups and heads and shoulders and double dips and all these type things. But it really um, takes a little bit of the emotional side out of the trade. A lot of the critics of his method say, it's just momentum investing. And maybe to an extent, they are looking at trends and you are trying to ride a trend out before maybe too many people jump on the bandwagon or before there's a market correction and those type of things. Maybe. I think there's a very logical side to the analysis that is done. And but all in all, this trading philosophy was probably the largest impact and something that I could immediately put into practice. I had mentioned that O'Neill includes some common investor mistakes, so I have listed a few here that I was guilty of, and so they may resonate with you. I was stubbornly holding on to losses when they were small and reasonable. I think this was probably with that emotional side of investing. I had made decisions and I was confident that they were going to pan out, yet the numbers were telling me that they were losing and they were not being profitable, yet I still held on to them. Somehow I felt that I was obligated to those decisions. That's kind of similar to the fourth point of cashing in small, easy to take profits while holding the losers. Uh, our portfolio has the ability to achieve greater gains, and we are anchoring it down with the losers. Again, we're not obligated to them. We should be able to rationally, when we think about it, to cut them loose and reinvest in something that will be profitable to us. Buying old names you're familiar with, I guess we can really only expect the mediocre returns, and I think that was really listed as a mistake because O'Neill really advocates going after the market leaders, doing the analysis to find the big wins. Um, Averaging down in price rather than up when buying, this was probably one of the major ones that I was guilty of because I was confident in my selection and I wanted to do cost averaging to bring down my average cost per share. Well, if the stock's going down and I'm buying more of it, all I'm doing is making myself, again, on the emotional side, feel better about paying a lower average price per share. But if the total direction in the investment is a loss, then I've really done nothing. So it's really better to add on or pyramid up when stock is increasing. That way you are
going in the right direction and adding more of that stock to your portfolio for good return. Concentrating your time on what to buy, and once the buy decision is made, not understanding when or under what conditions the stock must be sold. I really kind of hinted at this throughout the presentation, but doing the analysis, taking the time to choose correctly, but then what? Knowing when to cut the loss if the market turns against us or our decision turns out to be wrong, or breaking even, or cashing out when it's time to accept our profit. Well, I hope you have enjoyed this discussion of how to make money in stocks. Thank you so much for your time.